Hi, kids. This is me chilling in my basement on Sunday night. As you see by the fact that Mrs. Dawson is standing in front of you and I am not, I am still not here, like I said I would not be today. But we need to get a couple of things accomplished today. Number one, we need to review a little bit what happened last week in Chapter 1. And number two, we need to lay the foundation for what we're going to do pretty much every day for the rest of the year. So that's what we're going to accomplish here as we tootle on. I just wanted to wave at you. I know how much you all need to see my face every day to feel good, but this would be awkward for me to stare at this camera and have to talk to you. So the camera is going away now, and I will just start talking about what we talked about last week. Assets again equal our liabilities plus our owner's equity. That's the accounting equation that we just hammered last week over and over and over. We also said that every transaction has to balance and that our account totals when we are done with a transaction must balance. Early on, this will be pretty easy to do if we really wanted to check them all, because we're only dealing right now with a half dozen accounts. Even by the end of these next couple of chapters, it's not that many accounts. If you looked at the chosen ones in the back of the 6th-hour classroom, they would tell you that they're dealing with 100 to 150 account titles right now. So it's not always the easiest thing in the world to check all of your account totals to make sure they balance. The other thing we have to keep in mind is that even a small sole proprietorship will have anywhere from hundreds to maybe thousands of transactions to process in a fiscal period. And so we need to develop a system that allows us to record all these changes efficiently. As you can see by my Spanglish, it is mucho importante. So for all of these reasons, we're going to develop a system or we're going to learn a system where we use account balances. Every account we use is going to have some key pieces of information. We actually talked about this a touch last week. It's going to have a normal balance side, and it's going to have a way to increase the balance of an account and a way to decrease the balance of an account. So you can see here T on your screen, and on the top you see T accounts. That's not an accident. T accounts reinforce that idea that everything has to balance. What goes on the left has to equal what goes on the right of an equation. When we use T's, and we use them a lot as a learning tool, we use them especially as we get into more difficult transactions down the road and you're not quite sure what to do. Using this T and reinforcing the idea that everything has to balance is a big help. The account title would go on the top, and then we have the two sides, the left and the right. The left side we refer to as the debit side. Do not think of debit here like you do a debit card. It simply, in this case, means the left side. We use the initials DR to represent debit. Now, the smart ones among you, I was waiting for you to make fun of each other there for not being the smart ones. The smart ones among you are noticing that we use the initials DR and there is no R in debit. Well, the reason we use DR is because it aligns with the right side of the T, which we call the credit side, or CR. Do not think of credit card. Do not think of getting a credit on your account. CR and this, or credit, CR, simply means the right side. Debit is the left, credit is the right. So if you're facing the smartboard right now, the left side of the classroom with the 3 desks, that's the debit side. You can all refer to yourselves as the debits now. We'll have little games later, the debits against the credits. You think I'm kidding, but we really do that. Our assets then. We have dealt with 4 asset accounts: cash, accounts receivable, supplies, prepaid insurance. All 4 of these asset accounts and a majority of the asset accounts that we use will follow the same 3 rules. The debit side is the normal balance side. Another way of saying that is that assets have a debit balance. Now, the normal balance side is also the side that we will always use to increase the balance of an account. So if we want to increase the balance of our cash, our accounts receivable, our supplies, or our prepaid insurance, we know that we need to debit them. If we want to decrease the balance of an asset account, we know that we need to credit. So again, cash, accounts receivable, supplies, prepaid insurance, all of those have a normal debit balance. To increase them, we debit, meaning we want to increase the balance of our cash account or our supplies account. To decrease them, we would credit them. As far as liabilities and owner's equity accounts, right now we have 2 examples, and we've used the capital account. They're the opposite. Liabilities and owner's equity accounts, more often than not, have normal credit balances. And therefore, if we want to increase the balance of a liability or an owner's equity account, we need to credit them. And on the converse, if we want to decrease the balance of a liability or an owner's equity account, we need to debit them. So, quick review. Debit is the left side, credit is the right side. Assets have a normal debit balance, and that means that to increase them, it's always the normal balance side. So to increase an asset account, we would debit it. To decrease, we would credit it. Liability accounts are the opposite. Credit them for the normal balance, credit to increase them, debit to decrease them. You're going to practice with Mrs. Dawson now in Aplia. After you practice one, you're going to do one on your own. And when that's done, you're done for the day. It probably will be a little bit early. That's okay. Don't make mischief. Don't make Mrs. Dawson mad because she's my favorite sub. And if you make her mad and she doesn't come back, there will be punching. Goodbye, children.